Most people think 59.5 means one thing. You can finally pull money from your retirement account without paying the government a 10% bonus penalty for the privilege. That's true. But the actual leverage at this age isn't the withdrawal. It's the 13 to 15-year tax arbitrage window that opens right there and closes permanently the day your required minimum distributions kick in. That window is worth anywhere from $200,000 to $400,000 in taxes most people never have to pay. And the majority of Americans who spent 3 decades saving responsibly will leave almost every dollar of it on the table. That's what this video is about. Not the piggy bank, the window, and the real cost in actual dollars of not knowing it exists. Let me tell you what's actually happening here, because the framing the financial industry has given you about this age is structurally backward. Every piece of conventional content about 59.5 treats it as a withdrawal milestone. You can finally take money out without a penalty. Okay? And that framing turns your retirement account into a vending machine. What it completely ignores is that 59.5 also marks the beginning of the most valuable tax planning corridor in a working person's financial life. It's the space between you can access the money and the IRS tells you how much to take and sends you a bill. Inside that corridor, the rules are in your favor in a way they have never been before and will never be again. The cost of sleeping through it is not abstract. It is calculable. And I'm going to calculate it for you. Here's what I want to walk through today. 4 mechanics that, done correctly in the decade or so around this age, can reshape the tax profile of your entire retirement. Most of them are underused. 2 of them are almost never discussed, specifically in the context of this window. And every single one has a measurable dollar cost if you miss it. But before any of that, I need to give you the metaphor that holds all of this together. Because once you see it, you're going to see it everywhere. Imagine a fire sale. Real one. Liquidation event. Everything must go. Prices slashed to 70 cents on the dollar for goods you were going to buy anyway. But the store has a mandatory closing date. You don't choose it. You don't negotiate it. When it closes, it closes. Whatever you didn't buy at the sale price, you'll eventually buy at full retail. Not today. Maybe not for 10 years. But eventually. And the bill will be large. And you will not have a choice. That fire sale is the window between 59.5 and the year your required minimum distributions begin. For most people born before 1960, that's age 73. For people born in 1960 or later, which is a large portion of the people watching this, current law pushes the RMD start age to 75. This is the closing date. This is when the IRS arrives with its own cart, selects a percentage of your traditional retirement account balance, and generates a tax bill, regardless of whether you wanted or needed that withdrawal. The question is whether you shop at the fire sale first or wait for them to come to you at full price. Because waiting for them to come to you at full price is not bad luck. It is a planning failure and has a specific and completely avoidable cause. Now, in a few minutes, I'm going to show you a number buried inside the required minimum distribution math that most people encounter for the first time at 73 when responding to it is already too late. But I want to start with the move that creates the most leverage inside this window, and why most people who know about it still execute it wrong. The Roth conversion. You've heard the term. You may have nodded at a financial advisor who mentioned it once and quietly moved the conversation on. Here's what that nod may actually be costing you. The setup. You spent 20 or 30 years putting money into a traditional 401k or traditional IRA, pre-tax dollars. Every contribution went in before income taxes, which reduced your taxable income in the years you were earning your highest salary. Smart move, correct move. The problem is that money is not entirely yours in the way you think it is. Every dollar sitting in a traditional retirement account carries an IRS claim on it. They are a silent partner, a partner who put in $0 and expects a cut every time you make a withdrawal. You owe taxes on the contributions. You owe taxes on every dollar of growth. The principal and the compounding, all of it, all taxes ordinary income when it comes out. The IRS has been a stakeholder in your retirement savings the entire time. They just didn't mention it. A Roth IRA works differently. You contribute after-tax dollars. The money grows tax-free. When you pull it out in retirement, nothing owed. No tax on the principal, no tax on the growth, no required minimum distributions. The IRS gets paid once at contribution and never shows up again. A Roth conversion is when you take money sitting in a traditional account, pay the taxes on it now at whatever your current rate is, and move it to a Roth where it grows and withdraws completely tax-free. The strategic question is when. And the answer is when your income is at its lowest, your bracket is at its floor, and you have maximum control over what your taxable income looks like in a given year. Think about the timing. You're 60 or 61. You retired or you gone part-time. Social Security hasn't started yet. 62 is the earliest you can claim. And if you're being smart about it, you're almost certainly pushing that decision well past 62. Your required minimum distributions are 13 plus years away. Your taxable income this year may be the lowest it has been since your late 20s. You are, without realizing it, standing inside the fire sale. The shelves are stocked. The prices are low. The closing date is on the calendar. The question is whether you're paying attention. Here is a number that makes this concrete. The 22% federal tax bracket for a married couple filing jointly in 2025 extends to approximately $204,000 in taxable income. A couple who retired at 60 and has $40,000 in part-time income has roughly $160,000 of room between their current income and the top of the 22% bracket. Every dollar they convert from traditional to Roth while staying within that bracket gets taxed at 22%, not 24, not 32, 22 cents on the dollar. That is the sale price. That is what it costs them to permanently remove that money from the IRS's future reach. If they convert $80,000 per year for 8 years, staying inside the bracket, using that available room systematically, they've moved $640,000 from traditional to Roth. They've paid roughly $17,600 in federal tax per year on those conversions. In exchange, they've permanently removed $640,000 plus all future growth on it from the government's hands. That money compounds tax-free. It withdraws tax-free. When it passes to heirs, a 10-year tax-free growth window applies. The IRS got paid once, then they were done. Here is the reversal I want you to sit with, because it reframes almost everything. The conventional story says, if you didn't save enough, you have a savings problem. True for many people. But for a different group, people who are disciplined, who max their 401k every year without fail, who never touched it, the problem is not that they save too little. The problem is that they save too much in the wrong bucket. They built an enormous traditional account balance with essentially no tax diversification. The IRS has a proportional claim on their success. They did everything right and inadvertently created a compounding tax liability. The Roth conversion window is the mechanism to fix that. But it only works if you start before the fire sale closes. There is a trap inside the Roth conversion strategy, a trap with a name, and I need to come back to it in a moment because it changes how you time and size these conversions. File it away. I also want to introduce you to someone whose story is going to make the math feel real. His name is Robert. Keep that name in mind. By the way, hit subscribe if you're finding this useful. YouTube's algorithm has a short memory. If you don't subscribe, there's a real chance it stops surfacing my content to you entirely. I read the boring documents, so you don't have to. That seems like a fair exchange. Now, the trap, and the actual cost of letting a traditional account compound uninterrupted until the government forces your hand. Social Security benefits are only partially taxable, but the taxable percentage rises as your combined income increases. For individuals, once combined income crosses $32,000, up to 85% of your Social Security benefits become subject to federal income tax. For married couples, the threshold is $44,000. So when a large required minimum distribution lands at 73, sitting on top of your Social Security income, you don't get taxed twice. It's worse than that. The RMD raises your total income, which makes more of your Social Security taxable, which increases your effective marginal rate on each additional dollar, sometimes to an effective rate well above 30% when both effects compound together. That is the tax torpedo. It's not a scare tactic. It's arithmetic. And it disproportionately punishes people who saved responsibly and delayed Social Security correctly, people who did the right things. Let me show you Robert. Robert spent 32 years in operations management at a manufacturing firm in Indiana. maxed out his 401k every year without exception, never borrowed against it, never panicked during a downturn. By 61, he has $1.1 million in his traditional 401k, a paid-off house, and $120,000 in a taxable brokerage account. He plans to retire at 63. Robert has heard of Roth conversions. His advisor brought it up once during an annual review in 2018. Robert nodded, said he'd think about it, and moved the conversation toward whether he should shift his bond allocation. He never thought about it again. Robert retires at 63 and leaves the 401k alone. It grows at 7% annually. By 73, 10 years later, $1.1 million has grown to approximately $2.16 million. Under the IRS Uniform Lifetime Table at age 73, the distribution period is 26.5 years. Robert's required minimum distribution in year one is roughly $81,500. He didn't ask for that income. He doesn't need it, but he receives it and owes taxes on every dollar. Add his Social Security he delayed to 68, so roughly $30,000 annually, and Robert's gross income in year one of required minimum distributions is approximately $111,000. The Tax Torpedo activates. Most of his Social Security becomes taxable. His effective federal tax burden that year lands somewhere between $18,000 and $22,000 every year for as long as he lives, whether he spends the money or not. Now compare that to Robert if he had executed a methodical Roth conversion starting at 63, converting $60,000 to $70,000 per year. Staying within the 22% bracket, he moves approximately $560,000 from traditional to Roth over 8 years. He pays roughly $13,000 to $15,000 in federal tax annually on those conversions, shopping at the fire sale price. At 73, his traditional account balance is around $1.3 million instead of $2.16 million. His RMD is approximately $49,000 instead of $81,000. The torpedo is diffused. His Roth IRA, compounding tax-free since 63, has reached roughly $380,000 and generates tax-free income whenever he chooses to draw it. The lifetime difference in taxes paid between the version of Robert who converted and the version who didn't, conservatively modeled, $250,000 to $300,000. That's not a rounding error. That's not a projection artifact. That's the fire sale, run every year for 13 years, with a visible sign that Robert walked past without looking up. I'm going to come back to Robert once more before the end of this video, because there's one more thing in his situation unrelated to Roth conversions that almost cost him far more than the tax problem. But first, I need to tell you about the thing that sends people physically back to work when they thought they were finished: healthcare. Specifically, the invisible subsidy your employer has been quietly running on your behalf for your entire career, and the number you will see for the first time the morning you retire before 65. If you've spent your career at a company that covered your health insurance, you have likely never seen the actual premium. You've seen your paycheck deduction maybe $300, maybe $400 a month. That number represents approximately 15 to 25% of the real cost. The rest of it, your employer's contribution, has been running in the background invisibly. The Kaiser Family Foundation has tracked employer-sponsored health insurance for years. The average total annual premium for a family plan in the United States is well over $23,000. Your paycheck stub was showing you the discount version. The full price was always there. You just never had to see it. The day you retire before 65, the employer contribution disappears. COBRA lets you stay on your former employer's plan for up to 18 months. You now pay your share plus your employer's share plus a 2% administrative fee. You went from $350 a month to potentially $1,400 easily. And COBRA ends after 18 months, so if you retired at 63, you still have a gap before Medicare eligibility at 65. On the ACA marketplace, subsidies are available based on projected income. But here's the interaction nobody models before they retire. Your Roth conversion amounts count as income for ACA purposes. A $70,000 Roth conversion in the same year you're applying for ACA, subsidies can push your income above the subsidy threshold and cost you $10,000 to $15,000 in additional premiums. The two strategies collide. You cannot optimize them independently. They have to be modeled together with actual numbers before you make any decisions. A healthy couple in their early 60s buying a silver tier ACA plan in a mid-cost market with limited subsidy eligibility is looking at $24,000 to $36,000 per year in premiums, before deductibles and before copays. A retired attorney I know, sharp person, financially prepared, the kind of person who builds spreadsheets for fun, had planned his early retirement at 63 down to the line item. He had included healthcare in the budget. He'd allocated $12,000 per year for the two of them because that was what 20 years of paycheck stubs implied the company plan had cost his family. His actual ACA marketplace premium came back at $29,000. I thought the number looked wrong, he told me. It didn't look wrong. He went back to work. He did not want to go back to work. And this is not unusual. It happens with remarkable consistency to people who are otherwise excellent planners. The healthcare gap is the most common financial surprise in early retirement. Budget it as a hard number, not a rough estimate. A line item with the same weight as your mortgage. Now, this next part genuinely surprises people, including people who consider themselves well-researched on this topic. If you're between 60 and 63 right now and still working with 401k access, pay particular attention here. Thanks to Secure 2, which took effect in 2025, there is a 401k contribution window specific to ages 60 through 63 called the Super Catch-Up Contribution, and most people have simply never heard of it. Here's the context. The standard 401k contribution limit in 2025 is $23,500. Workers over 50 get an additional $7,500 as a catch-up, bringing the total to $31,000. That's been around for a while. But for ages 60 through 63 specifically, the catch-up contribution jumps from $7,500 to $11,250. Your total 401k contribution capacity for those 4 years is $34,750 per year, $11,250 instead of $7,500, an extra $3,750 annually over someone who is 55. Over 4 years, that's $15,000 additional dollars in pre-tax contributions. And if you compare the maximum contributions during ages 60 to 63 against the standard adult limit, those 4 years allow for roughly $45,000 in additional 401k savings that a person outside that age range cannot access. At 7% annual growth compounding over 12 years, from an average contribution age of 61 to RMD age 73, $45,000 in extra contributions becomes approximately $101,000. The window is 4 years wide. It opens at 60, it closes at 64, and you drop back to the regular catch-up rate. And the pattern I see described repeatedly is this. Most people between 60 and 63 who are still employed have mentally started their retirement. They're spending a little more, contributing a little less. I'm basically there anyway. They are standing at the fire sale checkout and walking away from the cart. $100,000 left on the shelf. And now Robert's last detail. The one that had nothing to do with tax brackets. During the account consolidation process, when Robert finally sat down with a fee-only CPA who showed him all of this, they reviewed every retirement account he held. Among them was an IRA rollover from a company he left in 2004. His first wife, divorced that same year, was still listed as the primary beneficiary. Nobody had caught it. Not his current advisor, not his estate attorney, not Robert himself. In 21 years of annual reviews and portfolio check-ins, that beneficiary form had sat there, unchanged, perfectly legally enforceable. Here's what most people don't know about beneficiary designations on retirement accounts. They override your will. Completely. It does not matter what your will says. It does not matter what your intentions are. Whoever's name is on that form receives the account. Period. The will is irrelevant. The probate court is irrelevant. The form controls 10 minutes to update. Robert updated it. The consequences of not updating it would have been, to put it gently, significant. Now, before I get to the practical steps, Let me close the Social Security loop because it connects directly to whether any of this planning actually pays off. If your full retirement age benefit is, say, $2,000 per month at 67, claiming at 62 gets you approximately $1,400. Claiming at 70 gets you approximately $2,480. You forego 8 years of payments to wait, but after the break-even age, which typically falls around 80 to 82, every additional year generates more lifetime income from the delayed strategy than from claiming early. Here is the connection. Delaying Social Security to 68 or 70 means your income between 62 and 69 sits at its natural floor. That's your Roth conversion window. That's the fire sale in full swing. You use those low-income years to convert, to manage your ACA threshold, to load your Roth. Then at 70, you flip the Social Security faucet on at the highest possible monthly rate. You arrive at your 70s with a smaller traditional account, a larger Roth, lower RMDs, and maximum guaranteed income. This is not a lucky outcome. It is a designed one. Every decision in the window feeds the next. 3 specific actions calibrated to this window, not generic advice. 1. Run your RMD projection before the end of this year. Take your current traditional IRA and 401k balance. Assume 6 to 7% annual growth and project it to age 73 or 75. Look at what that math forces you to withdraw in year 1. Add your expected Social Security income. Check your likely tax bracket. If that combined number pushes you toward 24 or 32%, you have a conversion opportunity this year before December 31st. Fidelity and Vanguard both have free calculators for this. It takes 20 minutes and it will show you a number worth knowing. 2. Price your healthcare gap today, not when you retire. Go to healthcare.gov, enter your age, zip code, and your projected retirement income, including any Roth conversions you plan to execute. Look at the actual premium. Compare it to what you've budgeted. If there's a gap, adjust your retirement timeline or your savings target before you're standing at the counter. The people who get blindsided by this number are the ones who never looked at it while they still had time to respond. 3. If you are between 60 and 63 and still employed with 401k access, call your plan administrator this week and confirm your plan has implemented the Secured 2 Super Catch-up limit. Not every employer payroll system updated automatically. There are people who assumed the higher limit applied and discovered in the following March, reviewing their tax documents, that the system had capped them at the old rate. The year is closed. The money is gone. Confirm the limit is active. Adjust your deferral percentage. The window is 4 years. Each year you under-contribute is a year you cannot get back. Lazy investing built more fortune than crypto memes. And the tax code rewards the people who showed up to the fire sale. Everyone else pays full retail every year for however long they live. The store was open the whole time. The hours were posted. Most people just didn't look.